Have you ever sold an investment and then watched it skyrocket, making you feel like you just threw away your financial future? Why do some Americans buy and sell constantly but stay broke, while others buy once and build generational wealth? The broke investor asks, "What should I buy next?" The wealthy investor asks, "What should I never sell?" Most Americans are trapped in the buying and selling hamster wheel, constantly looking for the next big thing instead of holding on to great things forever. Today, I'm revealing the 5 specific assets I own and will never sell. Not during crashes, not during panics, not even if someone offers me 10x what I paid. These aren't just investments. They're freedom engines that work while you sleep and build wealth while the world panics. But here's the kicker. Asset number 5 is something most people completely ignore. Yet, it has infinite return potential and can never crash to zero. Hit subscribe and comment "Never sell" if you've ever regretted selling too early. Look, everyone talks about what to buy, but here's what nobody talks about. Asset 1. Broad market index funds, the foundation of forever wealth. The first asset I'll never sell is the most boring investment in the world, and that's exactly why it's the most powerful. While Americans are obsessing over picking the next Tesla or avoiding the next Enron, I'm quietly owning pieces of every successful company in America through broad market index funds. Most people have this completely backwards. They think investing success comes from being smart enough to pick winners and avoid losers. But here's the brutal reality. 85% of professional fund managers, people with Harvard MBAs, Bloomberg terminals, and teams of analysts, can't beat the market over time. If the pros can't do it, what makes you think you can? The average American investor chases hot stocks, panics during crashes, and sells at exactly the wrong time. They buy high when everyone's excited and sell low when everyone's scared. This emotional roller coaster destroys wealth faster than any market crash ever could. But there's an ancient Roman principle that solves this problem perfectly. Roman military engineers understood that the strength of their legions came not from individual heroic soldiers, but from the disciplined formation of the entire army working together. They called it strength through unity. The idea that collective power always beats individual brilliance over time. This is exactly what broad market index funds represent. Instead of betting on individual companies, you're betting on the collective strength of American capitalism. You own tiny pieces of Apple, Microsoft, Amazon, Google, Walmart, and 3,000 other companies, all working to generate profits for you. Warren Buffett proved this principle definitively. In 2007, he made a $1 million bet with a hedge fund that a simple S&P 500 index fund would outperform their sophisticated stock-picking strategies over 10 years. The result? The index fund crushed the hedge funds by a massive margin. Buffett's boring index fund returned 125%, while the hedge funds averaged just 36%. Here's your actionable step. Open an account with Vanguard, Fidelity, or Schwab and buy one of these 3 funds: VTI, Vanguard Total Stock Market, FXAIX, Fidelity 500 Index, or SWTSX, Schwab Total Stock Market. These funds give you ownership in virtually every profitable company in America for expense ratios as low as 0.03% annually. Set up automatic investing, $500,000, whatever you can afford monthly, and never stop. Not during market crashes, not during recessions, not when the media screams that the world is ending. The key is dollar cost averaging, buying the same amount every month, regardless of market conditions. Let me show you the magic of this strategy. If you invested $500 monthly in VTI from age 25 to 65, you'd have over $1.5 million despite contributing only $240,000. That extra $1.26 million comes from compound growth and reinvested dividends. No stock picking, no market timing, no stress, just systematic wealth building. But here's why I'll never sell. These funds are self-cleansing. When companies become unprofitable, they automatically get removed. When new companies become successful, they automatically get added. You're always owning the best companies in America, without having to research, analyze, or make difficult decisions. During the 2008 financial crisis, individual stocks lost 50 to 90% of their value. Many never recovered, but the S&P 500 index fund recovered completely within 3 years and went on to new highs. During the 2020 pandemic crash, it recovered in just 5 months. The wealthy understand something most people miss. You don't need to be the smartest investor in the room. You just need to own the room. Broad market index funds let you own the entire room of American business success. This is my foundation asset because it removes emotion, eliminates stock-picking stress, and guarantees you'll capture whatever returns the overall market generates. It's boring, predictable, and absolutely unstoppable over time. But that's just the foundation. What I'm about to say is what makes the difference between good returns and great income. Asset 2. Dividend Aristocrats. The income machines that never stop paying. What I'm about to say is what makes the difference between good returns and great income that pays you whether the market goes up, down, or sideways. While most Americans chase stock price appreciation, hoping to sell for a profit someday, I own companies that pay me to hold them forever. These are called Dividend Aristocrats, companies that have increased their dividend payments for 25+ consecutive years. Think about that. Through recessions, wars, pandemics, inflation, and market crashes, these companies kept paying shareholders more money every single year for over 2 decades. Most people completely misunderstand dividends. They think dividends are just small payments that don't matter much. But here's what they're missing. Dividend-paying stocks don't just give you income, they give you compound income that grows automatically year after year. There's a Jewish teaching about a wise farmer who was offered 2 gifts by a wealthy merchant: a bag of gold coins or a young fruit tree. The farmer's neighbors mocked him when he chose the tree. "Take the gold," they said. "You can buy whatever you want right now." But the wise farmer understood something they didn't. He explained, "Gold coins can be spent only once, but a fruit tree bears fruit every season for generations. My children and my children's children will eat from this tree long after the gold coins are forgotten." This is exactly what Dividend Aristocrats represent. Trees that bear fruit every quarter, and the fruit gets bigger every year. Let me give you a real example that will blow your mind. Coca-Cola has paid dividends for 60 consecutive years and increased those payments for 40 straight years. If you bought $10,000 worth of Coca-Cola stock in 1983, you'd be receiving over $5,000 annually in dividend payments today. That's 50% of your original investment coming to you every year in cash. Plus, your shares are worth over $500,000. You didn't have to sell anything, time, any markets, or make any difficult decisions. You just held the stock and collected bigger checks every year. Here's your actionable criteria for identifying Dividend Aristocrats to hold forever. The 25-year rule. Only buy companies that have increased dividends for 25+ consecutive years. This proves they can maintain payments through any economic condition. The payout ratio test. Look for companies paying out 40 to 60% of their earnings as dividends. This leaves room for growth while ensuring sustainability. The moat requirement. Choose companies with competitive advantages, brands like Johnson & Johnson, utilities like NextEra Energy, or essential services like waste management. The reinvestment strategy. Set up dividend reinvestment plan strips so your dividends automatically buy more shares, which generate more dividends, creating compound income growth. My favorite Dividend Aristocrats include Coca-Cola, Johnson & Johnson, Procter & Gamble, McDonald's, and Walmart. These companies don't just survive recessions, they thrive during them because people still need consumer goods, healthcare, food, and household products. But here's why I'll never sell these income machines. Selling a Dividend Aristocrat for a quick profit is like cutting down a fruit tree to sell the wood. You might get some immediate cash, but you've destroyed decades of future income. During the 2008 financial crisis, while growth stocks crashed 50 to 70%, My Dividend Aristocrats kept paying me. In fact, many increased their dividends during the crisis because they had strong balance sheets and consistent cash flow. The math is powerful. If you own $100,000 worth of Dividend Aristocrats, yielding 3% annually, you receive $3,000 per year. But if those dividends grow by 7% annually, the historical average for Aristocrats, you'll be receiving $6,000 per year in just 10 years and $12,000 per year in 20 years, all without selling a single share. This is how you build passive income that grows faster than inflation and provides financial security regardless of market conditions. Wait, there's something you need to pay attention to if you don't want to lose everything to the one asset class that provides both income and tangible value. Asset 3. Income-producing real estate, the tangible wealth builder. There's something you need to pay attention to if you don't want to lose everything to inflation and market volatility. You need to own the one asset class that provides both growing income and tangible value you can see, touch, and control. Income-producing real estate. This is where I made my biggest financial mistake, and I'm sharing it so you don't repeat it. I bought a duplex for $180,000, fixed it up, and was collecting $2,400 monthly in rent. 2 years later, I got greedy and sold it for $250,000, thinking I was brilliant for making a quick $70,000 profit. Fast forward to today, that same property is worth $420,000 and generates $3,200 monthly in rent. I didn't make $70,000. I lost over $300,000 in appreciation, plus $38,400 annual income that I'll never get back. I traded a cash-flowing asset for a one-time profit, and it haunts me every day. The ancient Babylonians understood what I didn't. Land ownership was the foundation of all lasting wealth. There's a 4,000-year-old Babylonian proverb: "A man's house is his castle, but the land beneath it is his kingdom." They knew that while buildings could be destroyed, land was eternal and irreplaceable. But here's what most Americans get wrong about real estate. They treat it like a trading vehicle instead of an income-producing machine. They flip houses for quick profits instead of building rental empires that pay them forever. Real estate is the only investment that gives you 4 distinct ways to build wealth simultaneously. Cash flow. Monthly rent checks that typically increase with inflation. My current properties generate $4,800 monthly after all expenses. That's $57,600 annually in passive income. Appreciation. Real estate historically appreciates 3 to 5% annually, but in good markets it can be much higher. My portfolio has appreciated by over 8% annually for the past decade. Equity buildup. Every month, tenants pay down my mortgages, increasing my ownership percentage. It's like having someone else make your car payments while you keep the car. Tax advantages. Depreciation, mortgage interest deductions, and maintenance expenses shelter my rental income from taxes. Sometimes I pay 0 taxes on $50,000 in rental profits. Here's your actionable strategy for building a rental empire. Use the 1% rule as your starting filter. The monthly rent should equal at least 1% of the purchase price. A $200,000 property should rent for at least $2,000 monthly. Calculate real cash flow by subtracting all expenses: mortgage payments, taxes, insurance, maintenance reserves, vacancy allowances, and property management fees. If it's not cash flow positive from day one, don't buy it. Focus on growing markets with job diversity, population growth, and strong rental demand. Avoid one-industry towns that can collapse if the main employer leaves. Buy properties you can afford to hold through any market condition. Use conservative financing. Never stretch to buy the most expensive property you qualify for. But here's why I'll never sell my rental properties again. Real estate is the ultimate inflation hedge. When costs go up, rents go up. When the dollar weakens, property values rise. When stocks crash, people still need places to live. During the 2008 financial crisis, my stock portfolio lost 40% of its value overnight. But my rental properties kept generating monthly income, and smart investors who bought during the crash made fortunes as the market recovered. The tax advantages alone make holding forever worth it. When you die, your heirs receive a stepped-up basis, meaning they can sell inherited properties with no capital gains taxes. This turns real estate into generational wealth that compounds across decades. Plus, real estate gives you control that stocks never can. You can improve properties to increase rents, refinance to access equity, and make strategic decisions that directly impact your returns. I've learned that in real estate, time in the market beats timing the market. Every month you hold a cash-flowing property, you're building wealth through multiple channels simultaneously. Don't jump to conclusions, because what comes next can change your perspective completely about owning pieces of the companies that will dominate the future economy. Asset 4. Dominant tech growth companies. Owning the future economy. Don't jump to conclusions, because what comes next can change your perspective completely about the biggest wealth creation opportunity of our lifetime. Owning pieces of the companies that will dominate the future economy. Most Americans have the completely wrong relationship with technology stocks. They either avoid them entirely because they seem risky, or they trade them like gambling chips, buying when they're hot and selling when they cool down. Both approaches miss the real opportunity, identifying dominant technology companies and holding them through their entire growth journey. Here's the painful truth. If you had bought Amazon stock for $1,000 in 2002 and held it for 20 years, you'd have over $180,000 today. But most people who bought Amazon sold it multiple times along the way, during the 2008 crash, during various corrections, or when they thought it was overvalued. They turned a potential 180x return into modest profits. The ancient Roman emperor Marcus Aurelius understood the principle of backing winners and sticking with them. He wrote, "A horse does not know its own strength until it is tested by the longest journey." Marcus Aurelius knew that true champions reveal themselves not in short sprints, but through sustained performance over time. This is exactly how you should think about dominant technology companies. You're not betting on quick price movements. You're betting on long-term economic dominance. But here's what separates real tech winners from fads. Dominant tech companies solve fundamental human problems and become more valuable as they grow larger. Amazon didn't just sell books, it solved the problem of convenient shopping and built infrastructure that gets stronger with scale. Apple didn't just make phones, it created an ecosystem that becomes more valuable as more people join it. Here's your actionable criteria for identifying tech companies to hold forever. The network effect test. Look for companies that become more valuable as more people use them. Facebook, Google, and Amazon all benefit from network effects. Each new user makes the platform more valuable for everyone. The moat expansion. Great tech companies use their success to build bigger competitive advantages. Amazon used e-commerce profits to build AWS cloud services. Google used search dominance to expand into advertising, Android, and cloud computing. The platform power. The best tech investments are platforms, not just products. Microsoft, Apple, and Google created platforms that thousands of other companies build upon, generating ecosystem revenues that compound over time. The secular trend. Focus on companies riding unstoppable long-term trends like artificial intelligence, cloud computing, or mobile activity, not short-term hype cycles. My current never-sell tech holdings include Microsoft, cloud computing dominance, Apple, ecosystem lock-in, Google, advertising and AI leadership, and select AI-focused companies that are building the infrastructure for the next economic revolution. But here's why I'll never sell these positions. Technology markets are winner takes all. The dominant platforms don't just succeed. They capture most of the industry's profits, while competitors struggle for scraps. Google controls 90% of search. Amazon dominates cloud infrastructure. Apple captures 80% of smartphone industry profits. The key is surviving the volatility. Tech stocks can drop 30 to 50% in market downturns, but the underlying businesses often emerge stronger. During the 2020 pandemic crash, Netflix, Amazon, and Microsoft initially fell with everything else, then soared to new highs as the world went digital. I learned this lesson from studying Warren Buffett's approach to Coca-Cola. He bought it in 1988 and held through multiple market crashes, recessions, and overvaluation periods. Today, Berkshire Hathaway receives over $700 million annually in Coca-Cola dividends, more than their entire original investment. The same principle applies to dominant tech companies. If you find the right ones and hold through the inevitable volatility, the long-term wealth creation can be extraordinary. Technology is eating the world, and the companies that lead this transformation will create more wealth in the next 20 years than most traditional industries created in the past century. It sounds simple, but the hardest part is what's about to be told next. The one asset that can never crash to zero and has infinite return potential. Asset 5. Your skills and personal brand. The infinite return investment. It sounds simple, but the hardest part is what's about to be told next. Recognizing that the most valuable asset you'll ever own isn't something you can buy in any market. It's something you must build within yourself, your skills and personal brand. This is the only asset that can never crash to zero, can't be stolen by hackers, won't be destroyed by inflation, and has unlimited return potential. Yet 99% of Americans spend more time researching which stock to buy than developing the skills that could 10x their income. Most people treat their career like a job instead of like a business. They show up, do the work, collect the paycheck, and hope someone else will make them wealthy. But the wealthy understand something different. They are their own most valuable asset, and they invest in themselves more aggressively than any stock or real estate. There's an ancient Greek principle called arit, the pursuit of excellence and virtue that makes a person valuable to society. The Greeks understood that knowledge and skill were the only treasures that could never be taken from you. Wars could destroy your property, thieves could steal your gold, but wisdom and ability travel with you forever. Aristotle taught his students, excellence is never an accident. It is always the result of high intention, sincere effort, and intelligent execution. The Greeks knew that investing in human potential generated returns that compounded infinitely across a lifetime. Here's why your skills and brand are the ultimate never-sell asset. They're the force multiplier for every other investment you make. A person with high-value skills earns more money to invest. A person with a strong personal brand gets better opportunities. A person with deep expertise makes better investment decisions. Let me give you a real example. Tony Robbins didn't become wealthy by investing in index funds. He became wealthy by developing world-class skills in psychology, communication, and business strategy. Those skills allowed him to build businesses, command premium speaking fees, and attract investment opportunities that generated exponential returns. But here's the actionable strategy for building this asset. The high-value skill strategy. Identify one skill that can dramatically increase your income. Sales, coding, digital marketing, copywriting, public speaking, or specialized expertise in your field. Then invest 1 to 2 hours daily in mastering it. The personal brand blueprint. Document your expertise journey publicly. Write about what you're learning, share insights on LinkedIn, and create valuable content that demonstrates your knowledge. People pay premium prices to work with experts they know and trust. The network multiplication. Your skills open doors to relationships with other high-value people. Those relationships create opportunities, partnerships, and deals that you can't access any other way. The recession-proof principle. When markets crash and companies lay off workers, they keep the people who generate the most value. If you're known for solving expensive problems, you stay in demand regardless of economic conditions. The mathematics of skill development is incredible. If learning a new skill increases your income by just $10,000 annually, that's $400,000 over a 40-year career. But skills compound. Each new capability builds on previous ones, creating exponential growth in earning potential. Your personal brand works the same way. When you're known for excellence in your field, you can charge premium prices, attract better opportunities, and build businesses around your expertise. People don't just buy products or services, they buy from people they trust and respect. But here's why you can never sell this asset. The moment you stop developing your skills and brand, they start depreciating. Unlike stocks or real estate, which can generate passive returns, your human capital requires continuous investment to maintain its value. The wealthy understand that they are their own best investment. Warren Buffett spends 80% of his day reading and learning. Bill Gates takes think weeks to study and plan. They know that investing in their own knowledge and capabilities generates higher returns than any external investment. Your skills and brand are the foundation that makes every other wealth-building strategy possible. Without earning capacity, you can't buy index funds. Without expertise, you make poor real estate decisions. Without a strong brand, you miss the best opportunities. All of the above will be meaningless. If you miss the last detail about shifting from a trader's mindset to a builder's mindset, all of the above will be meaningless. If you miss the last detail about shifting from a trader's mindset to a builder's mindset, because that's what separates people who get rich from people who stay rich. Here's the brutal truth. Poor people ask, what should I buy next? Rich people ask, what should I never sell? The difference isn't just strategy, it's psychology. Traders chase quick profits and end up with quick losses. Builders accumulate assets and create generational wealth. Let's recap your 5 never-sell assets. Broad market index funds give you diversified ownership of American business success. Dividend Aristocrats pay you growing income every quarter for decades. Income-producing real estate provides cash flow, appreciation, and tax advantages that compound across generations. Dominant tech companies let you own pieces of the future economy, and your skills and personal brand generate infinite returns that can never crash to zero. Notice what they all have in common? They work while you sleep. They grow during market panics. They reward patience over panic. This is how real wealth gets built, not through clever trading, but through boring holding. Here's your new plan. Stop flipping, start holding. Stop chasing trends, start building foundations. Pick one of these 5 assets and commit to holding it for 20+ years, starting this month. Comment below which asset you're committing to hold forever. Are you starting with index funds, building a rental empire, developing high-value skills? I want to hear your never-sell strategy. Remember this. The goal isn't to get rich fast. It's to get rich for life and pass that wealth to the next generation. Stop selling your future. Start building your legacy.